Welcome to ACCA paper F9 on financial management. Today we're going to spend a few minutes to talk about business valuations. Now, valuing businesses or valuing any kind of property is so central to a properly functioning free market economy that we need to consider here some of the key methods that are used in putting a value on a business. Let's just look at some of the models then. If we are going to put a value on shares of a business, effectively value of 100% equity value of a business. Starting with book value methods, this is sort of the most tangible way in which we look at the tangible assets of a business in order to form an opinion of what the replacement value could be, or based on revaluations of tangible assets to current market values. That's one way of thinking about the value of a business or possible value. If there are significant intangibles, then these need to be taken into account as well in order to arrive at a proper possible value for a company. I say possible simply because the methods we talk about here are not mutually exclusive, in the sense that a practitioner in valuation should look at a company from a number of points of view to understand better what its key value drivers are and what could form the basis of the price that a buyer might be willing to pay for such a business. Now, we also have, in addition to asset-based methods, market relative methods, we can call them. One is the price-earnings ratio, which is a very common basis or method for looking at the value of a share. It has limitations, of course, because no two companies are necessarily alike, and therefore the PE is a bit superficial in what it does. PE being defined as the price per share divided by the earnings per share, or it's a multiple of earnings that one is effectively buying when one pays for a share. Now, the assumptions to make the PE ratio as useful as possible is we should be comparing companies, of course, in the same business area, so the business risk is similar. And if we can find similar companies with similar capital structures, that means debt, equity, structure, level of gearing, then the financial risk should be largely the same. In addition, if we're really going to try to develop a peer group of similar companies, then we would want to find companies that were more or less in the same growth rate category. Another way of looking at the value of business is through the earnings yield. That is simply the reciprocal of the PE ratio. And now let's turn our attention to cash flow based methods of valuation. Now, this will be familiar to the students. It's the dividend valuation model. It's placing a value on the shares of the business by looking at the dividend stream and saying, if we were to model and then discount back the dividends that are payable or expected to be paid by a company, then we can determine what the price of a share is. So this formula has been encountered before, and it's simply being placed at the service of those who wish to value the business through its dividend payments. This would be typical for a small investor who has no significant influence over a company, that can simply buy the company, earn the dividend flows, and if they don't wish to be exposed to the company anymore, they can sell the shares again. In other words, they can express their dissatisfaction with share performance by walking. In other words, selling the shares to someone else. Now, the most robust method of determining the value of a business is the discounted cash flow method. This is where we take the free cash flow of a business, the surplus cash that's being generated by a business which is available to capital providers, and we model the free cash flows into perpetuity because the presumption is that a company is expected to last forever, or at least that's the working assumption we make. Now, what we do when we calculate the free cash flows is we work out a so-called forecast horizon of cash flows. This is going to be for a limited period, typically 5 years, to see what the cash revenues and cash inflows and outflows of the business are, including expenditures and capital expenditures, CapEx, and working capital investments. Having done that, we need to make some assumptions with regard to the business after the forecast horizon, i.e. the continuing value. This is best appreciated by looking at the timeline we have here. Suppose we have a company for which we forecast its free cash flows over a 5-year period. You can see here the cash flows themselves. Now, we could carry this on into perpetuity, but of course it gets a little bit boring and difficult to specifically model the cash flows after year 5 without becoming simply repetitive. Therefore, it makes sense from an economy point of view to make some continuing value assumption as to what all future cash flows, free cash flows, could be for this business as represented by the year 6 cash flow. When we achieve this, then we simply need to discount our free cash flows for the forecast horizon, add them together to the present value of the perpetual cash flows that occur from year 5 plus going forward. Now, we have to be careful to do the discounting correctly, because any perpetuity, even if it's a growing perpetuity, will have a present value which corresponds back to the last year of our forecast horizon, and therefore any number which corresponds to year 5 has itself to be discounted back to year 0. So we have truly all free cash flows properly converted to year 0 or present values, so that we can determine the value of the company. When we speak of free cash flows here, and understand this to be free cash flows to all capital providers, debt and equity, then of course, by calculating the present value of the forecast horizon, the terminal value, that gives us the enterprise value, or the total company value of the business, 15,132 in this case. And we would need to deduct from the enterprise or company value the amount of debt that the company has in its balance sheet in order to determine what the final equity value will be. So the discounted cash flow method for valuing businesses is rather a complex topic, not one that can be quickly summarized in a couple of pages, but actually takes up entire books to be understood and practiced properly. Now, of course, we should also be able to consider what the limitations are on various valuation models. Generally speaking, the methods that we use here, the financial mathematics, is largely the same as practiced or presented in earlier chapters of these express notes. Remember, redeemable debt, for example, is valued using net present value technique. If the debt is irredeemable, we have perpetuity formulas for this purpose, and convertible debt and preference shares can likewise be valued by determining what the cash flows are, finding appropriate discount rates at which those cash flows will result in the required return to investors. The final idea or concept here in this chapter deals with the efficient market hypothesis, and this is theories regarding how how strongly information that becomes known in the market is reflected in the price of a share. If we have strong efficiency, then we're saying that pretty much everything known about a company will be reflected in the share price, and therefore it will be difficult to be able to anticipate and be able to react fast enough to be able to take advantage of share price movements. On the other hand, if we have a weak form, this is the other extreme, weak form efficiency in the market, this suggests that share prices only adjust to actual steps that are taken by a company in the market. Neither the very strong efficiency or the weak form arguments or approaches to market efficiency really are borne out in the practical reality, and therefore I think most observers of the markets would tend to say that the markets are generally behaving in a way which is consistent with the semi-strong form of market efficiency. Thank you.